Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Invesco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Invesco is a real estate investment trust. The trust purchases and manages residential and commercial mortgage-backed securities and also mortgage loans. A mortgage-backed security is an investment similar to a bond that is made up of a bundle of home loans bought from the banks that issued them. Investors in MBS receive periodic payments similar to bond coupon payments. If there are 1,000 mortgage loans in a particular bond, and say 10 people default on their loan, the bondholders will still receive 100% of their principal and interest payments. If say 100 people default, then the junior bondholders may suffer losses. The junior bondholders receive a higher interest payment than the senior bondholders. If say 300 people default, then the senior bondholders may suffer losses. Shares of Invesco and other mortgage REITs went down about 80% in March 2020. The looming fear of a recession has tanked the value of mortgage-backed securities. Some mortgage REIT stocks have come up in value, but this stock is pretty flat since March 2020. It's still down around 80%. The company is headquartered in Atlanta, Georgia, and was founded in 2008. The ticker trades on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 700 million market cap. They're trading at $2.18 a share, and they have 330 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow has been going down from 300 million to 152 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they had a net loss of 90 million in 2021. Revenue is their interest income, and that was 169 million in 2021. This is the company's income statement from their 10K. The way the company generates cash flow is the interest income they receive on their investments. And that was 780 million in 2019. It's down to 169 million. Most of their interest income is from agency RMBS. Agency securities are backed by the government. Those include Fannie Mae, Freddie Mac, and Ginnie Mae. Non-agency securities are issued by banks like JP Morgan. I worked at JP Morgan for several years on these securities. CMBS are commercial mortgage-backed securities. RMBS are residential mortgage-backed securities. It is possible one of your mortgage loans is part of one of their bonds. Say Google needs a mortgage loan to buy a building in Manhattan. That mortgage loan may be part of one of the bonds in their CMBS portfolios. The Federal Reserve provides the repo loans, so Invesco can buy these mortgage-backed securities. If Invesco receives 5% interest on the mortgage-backed security and pays the government 3% for the loan, then Invesco makes a 2% return on that investment. That's the interest spread. That's how they make money. They borrow money at a lower interest rate and invest at a higher interest rate. Their net interest income in 2021 was 180 million. Their interest expense was negative 11 million, so that increases their income. That's why their income went up from 169 million to 180 million. In 2019 and 2020, their expense was positive, so it brought down their interest income. The reason they had negative interest expense in 2021 were due to gains on interest rate swaps. That's why I usually try to avoid doing these types of structures, because it's really confusing trying to understand everything with all this complexity. And based on the way interest rates move, they have to post gains or losses on their investments. But these are non-cash items, so they get reversed out on a statement of cash flows. It's not really helpful looking at the income statement when trying to understand a company. The only numbers that are straightforward are the interest income. All the other numbers are subject to confusing accounting rules. If you looked at their revenue on Yahoo Finance, it's negative in 2020, 2018, and 2021. It's impossible to have negative revenue. The reason it looks negative is all the accounting adjustments. So you can't really look at Yahoo Finance for this company. They also pass through fairly large gains and losses on derivatives. Their operating loss was 240 million. Last year was 1.8 billion. They also have to pay management fees and they have to pay their staff. Regular investors usually don't buy MBS because the minimum amount is $10,000. You could buy a regular treasury bond for $100 or a double E bond for $25. Large funds like a pension fund would buy mortgage-backed securities. But if you really wanted to invest in an MBS, there are ETFs that allow you to do that. This is their operating cash flow section. Operating cash flow is the first part of the statement of cash flows. The second part is investing and the third part is financing. And the way you calculate operating cash flow, you start with your net loss of $90 million. Then you have to add or subtract the non-cash items on the income statement. Even though they reported a net loss, they actually generated $150 million of cash flow. Last year, they reported a net loss of $1.7 billion, but generated $170 million of cash flow. The large net loss is due to mark-to-market adjustments. When they add back those non-cash adjustments, $859 million, $961 million, then we get the actual cash flow. For a company like this, I would definitely focus on operating cash flow. Net income doesn't make sense for this company. If I bought $100,000 of Peloton in the beginning of 2021, say at the end of 2021, the value of my Peloton stock was $200,000. Then on my personal income statement, it would show a gain of $100,000, an unrealized gain. And let's pretend at the end of 2022, my Peloton stock is back to $100,000, my original investment. On my personal income statement in 2022, I would show an unrealized loss of $100,000 on my Peloton investment because in the beginning of 2022, the value of my Peloton was $200,000 and at the end it was $100,000. But could you imagine if you own many stocks and you've had them for many years? In a bull market, you might see millions of dollars of gains. In a bear market, you might see millions of dollars of losses. But if you looked at your portfolio over a 10-year time frame, you may see an average annual growth of 10%. But if you looked at smaller time frames, you see these big spikes. So if an investor just looked at 1 year and saw a big loss of $1.7 billion, they would think it's a terrible company. If they happen to look at 2019's income statement, they would think the company's doing well. But if you combine 10 or 20 years, it would look normal. This is their investing section in their statement of cash flows and their financing section. In their investing section, you can see how much mortgage-backed securities they buy. $17 billion in 2021. Last year was $14 billion. Before that it was $9 billion. And they received $16 billion from the sale of those MBS securities. Last year was $25 billion. The way they fund these purchases is from repo agreements. $82 billion in 2021. Last year they received $75 billion. Before that it was $130 billion. They also issue common stock each year, $500 million in 2019, $420 million, then $430 million. Their dividends have been decreasing. It was $270 million in 2019. Now it's down to $133 million. But their stock price has come down so much, their dividend yield is higher than 2019. Here's a list of their assets on their balance sheet. They have $7.8 billion of MBS securities, $357 million of cash, $220 million restricted cash. Their restricted cash is used for hedging agreements, and they have a bunch of other smaller items. Here's a list of their liabilities. They owe $7 billion of repo agreements. They owe $30 million of dividends, and some other smaller items. This is the equity section on their 12/31 balance sheet. They have $1.4 billion of equity. They raised $150 million from selling Series B preferred stock and $278 million from Series C preferred stock. And they raised $3.8 billion from selling common stock. They have negative $2.9 billion of retained earnings. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. I gave them the highest whack on Finbox, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.7 billion. We divide that by 330 million shares. And we get a calculated stock price of $8.20. They're trading at $2.18, so they're trading at a 73% discount. It's a buy according to the model. It is a little difficult valuing a company like this due to all the complexities. So I just took an easy approach. I just grew their free cash flows 5% for the next 4 years. That's how I got their future free cash flows. 2 analysts priced this stock and the average price target is $2.30. The stock was over $18 a share before COVID hit, and then it crashed. It did increase to almost $5, but then it came back down. So it could be an opportunity to 2, 3, or 4x your investment. In the past 5 years, this stock is down 86%, while the S&P is up 107%. They pay a quarterly dividend of 9 cents. So to calculate the dividend yield, you multiply this by 4, that's 36 cents, and you divide by the stock price. That's a 16.5% dividend yield. It does look like they are able to afford that. It's 78% of their free cash flow. When the stock crashed in 2020, the dividend yield was over 60%. The lower the stock price, the higher the yield. But then they adjusted their dividend payment, but they're still paying an amazing dividend, a lot higher than average. And the forecast is for the company to maintain their dividend yield. They have a beta of 1.23, so the stock moves a little more than the market. It's down 45% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 204, the high is 460. And the stock is on a decline, trading below its 50-day and 200-day moving average. 6 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 55% are held by institutions, and 10.5% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have been at over $20,000 right before COVID. But if you're still holding on, you'd be at $3,600 today. That's a 64% loss. In the past year, there's been more insider selling than buying. 21,000 shares have been sold and 15,000 shares have been purchased. About half the shares are held by institutions and half by the general public. Insiders only own 0.2% of the stock. The biggest shareholder is BlackRock at 16%, then Vanguard, State Street, Murray, Asset Global, and Geode. The best way to look at ratios is to compare them to companies in the same industry. There are 40 companies in the same industry as IVR. And IVR pays a really high dividend, a lot higher than average. They rank 22nd in market cap. I would ignore price to earnings and price to sales for this company. It doesn't really make sense. You could look at price to free cash flow, but the best ratio is price to book. The lower the better, and they do have a good price to book. It looks like they have the best on this list, so it could be a great value right now. So to summarize, I have them trading at a 73% discount. But like I said earlier, I'm not sure if a DCF model is appropriate for this type of structure. I think price to book or tangible price to book would be a better way to value this company. It does get a little tricky with all the complexities and nuances of the structure. But if you felt comfortable owning the stock when it was over $15 a share, then now it seems like a great value. Bond values work opposite interest rates. So if interest rates go up, the value of a bond decreases. And if interest rates go down, the value of a bond increases. IVR stock price is really low, so I think that's already priced in. The market is already assuming high interest rates. That's why the stock is so low. I rank their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.